Hey everybody, it's Scott DiGregorio and Gardo Valentine. We're here in Primary Residential Mortgage in the Naples office.
Yeah, nice
How's
to
it
be
going,
down
man?
here. It's going great, man.
Yeah.
How are you?
Thank you for visiting.
Yeah.
So, we missed last week.
We did.
Sorry about that.
Life happens.
Yeah, that's right. But today we want to talk a little bit about, what's going on. What's going on in the past 2 weeks, and then we have a couple of questions for the past 2 weeks.
Yeah, and thanks for the questions, by the way, guys. Keep them coming to us.
Yes.
So we want to make sure that we're answering whatever's on your mind. Look, I want to start this week, man. So
Sure.
I had two of these scenarios happen this week, and it had to do with bridge loans, okay? And for those of you that don't know, a bridge loan is if you're going to sell one house and buy another, a bridge loan is kind of the short-term loan where you can tap into the equity on your existing house and use that as a down payment, right?
Benefits of that?
So the benefits of that is it takes away the need to have to sell the house and buy the house simultaneously.
Which is very attractive for somebody at face value.
Absolutely.
It's very attractive.
Absolutely.
Right.
So look, here's the problem with bridge loans. Okay, first off, not many people do them, and you might ask why. Well, it's simple. Everybody knows it's a short-term loan. Right. So generally speaking, bridge loans are pretty expensive from the fee side of things. Okay. And it's like there's still merit to it, but with both of these people, I came up with a better suggestion. So check it out.
Okay.
I had them, I advised them to take out a home equity line of credit on their current house.
Okay.
I know some banks will go up to 90% of the value of the house, which is basically all of their borrowable income or equity. And now, with most banks, if you take out a home equity line of credit and you close it out within 2 years, you generally got to pay a fee. I've seen it be $500.
It's minor. I have a HELOC up to 90% too, so the rate is a little bit higher. And same thing, if I close it, it's $500.
Yes, $500, whatever. But versus thousands and thousands on a bridge loan. All right. So what I advise them to do is take out a home equity line of credit up to 90%, use that as the down payment, and when they sell their house, their current house, HELOC gets paid off. $500, no big deal. And, look, the challenges with trying to close simultaneously are big, right? If you sell your house first, you might have to settle on the one you're buying, right? If you buy the house first, you might have to settle on the price of the home you're selling.
Right.
So if you could afford it, okay, and float both for a couple of months maybe, or, a reasonable period of time, the home equity line of credit gives you the best of both worlds. You could take your time to buy just the right house for yourself, and you can take your time and get as high of a possible price in the house you're selling. So, bridge loans, no. HELOC strategy, yes. It's just a good way to go.
Well, I'm going to break structure here a little bit because that brings up a question that we actually received from the past couple of weeks. I'm going to jump ahead of that.
Okay.
So what you're telling me is we are allowed to get a home equity line of credit, deposit that money into an account. Do we not need to have that money into that account for 2 months in order to be able to use it at all? Because the question that we got is, if somebody were to get a tax refund,
that's right.
In order for them to be able to buy a property, don't they have to wait for 2 full months before they can use that money to purchase a property?
And look, that's a big thing. So look, when we're talking down payment or when we're talking asset money, there's two options. You got sourcing and seasoning, okay? And look, the laws here are big. It has to do with the Patriot Act and Anti-Money Laundering Act and all kinds of laws. But so here's
it's not banks. It's not just that primary wants you to have
no,
money.
it's federal.
Correct.
Yeah, it's federal. So look, if it's in the account for 2 months, it's seasoned, right? We generally ask for 2 months worth of bank statements for a file.
Right.
Whatever happened prior to that, we don't know about. Okay, so that's seasoned. If it's not seasoned, it needs to be sourced. We just got to see where it's coming from. So if you get a tax refund and we see that it's an IRS refund that we could document and match up with the taxes, we're good. If you take out a home equity line of credit and dump into your account, we need some paperwork, but we could source it and we're good to go.
It's no different than your paycheck. You
100%.
Don't need to wait for that paycheck to be in the account for 2 months before you can purchase a home.
Absolutely.
It's the exact same thing. All we care about is we need to source that money. We need to know where it came from, and we need to know, again, because of the Patriot Act and the money laundering, that is not, it's not.
Yeah, look, it wasn't. I'll save you. I'll save you from that one, bro. Look, if you got a whole bunch of cash sitting in your sock drawer and you want to dump it into your bank and use it to buy a house, it's just simply not going to work. Okay. Right. So that's what has been going on in my world. I've had literally 2 of those recently.
Nice. Well, lately I've been having some refis.
Yeah, sure.
I've been having some refis, and I just think it's worth mentioning this because a lot of people are hearing that the rates are going up. And I know that we had a great month, but just macro, the picture is that the rates are going up. Therefore, it makes no sense ever to refi a property. And that's just not the case.
No.
It's not a case-by-case scenario. There's a lot of times where changing the loan program, maybe going from an FHA to a conventional
100%.
loan, might make a lot of sense because we can use that equity so your loan-to-value ratio is much lower, and we can drop that mortgage insurance, which at the end of the day is just an extra fee that you're paying. There's a lot of times where just for cash flow, even though your rate might be a little higher, because we're doing that loan at 30 years again, that might make sense.
Absolutely.
And there's a lot of times where we can do a lot of debt consolidation.
And I'm working, I must have 3 or 4 debt consolidation loans working now, where I got one I was actually working on yesterday with somebody I've known from yesteryear, and the monthly savings were close to $2,000. We were knocking off like 50 grand in debt. So yeah, there's a lot out there.
When we look at people's finances, I think it's very important, and it's very important for people at home that when they look at their finances, they don't just have a tunnel vision and look at the one payment. They need to look at the big picture.
Of course.
Because at the end of the day, it's not just the one number on the rate or what your car payment is going to be that's going to make your finances healthier or not. And I think it's very important to stress that. And there's different vehicles that you can take advantage of when you have equity in your property. And when you happen to live in Southwest Florida, where there's some equity still, houses are appreciating nicely, that it's sometimes very advantageous for people to take advantage of that.
Absolutely, but on the other side of it, we got to be careful, right? Rolling a car into a 30-year mortgage is problematic because guess what? At some point, you're going to have another car payment.
That's right.
So, we got to be, when I talk to people, particularly about debt consolidation, we got to think this through on an intelligent level, okay? Paying off a bunch of credit card debts and then running the credit cards back up is bad. And on the other side of it, the conversation needs to take place, and this is where I think you and I go a little bit deeper. Cool, you're saving $2,000 a month. What are we going to do with that money? Don't let that money, don't blow the money. Take that $2,000, maybe you make $500 for yourself and your spending and whatnot, but take what you can and do something smart with it, invest it, build it for the future, because then the benefits of this just compound.
That's right. And it's important to look at the situation of the person, because we're going to have very, very different conversation with somebody that tells us that this is their forever home. So maybe it will make sense to even raise that payment a little bit, but shorten the amount of the loan.
True.
Save them a lot of money in interest. Making a 15-year fix and keeping the same rate or lower. Sorry.
Busy man.
Yeah. They're not watching. Anyways, it's on a case-by-case scenario.
Absolutely.
And that's why that strategy session that we have at the beginning of things,
it's everything.
It's very important.
Yeah, it's everything.
Because not one loan fits all.
No,
and I think that's so important to explain to people.
Yeah, and it's so much more, like you're saying, it's so much more than just the loan, okay? An awful lot of loans I write are 30-year fixed rate loans, okay? That's a lot of them, but it's all this other stuff that comes into play, and that's why every strategy session is unique.
That's right.
So,
all right. So we have some questions from the last couple of weeks. I know that we're running out of time here. So the first question, it's about the market. There's a lot of speculation out there about what's going on with the market.
Yeah.
A lot of speculation, even from people in the industry, and they're pulling from 1,000 different directions.
Absolutely.
So the question is, we're entering season. We can definitely feel it outside.
Yeah, the traffic.
Yeah. So is it true that the prices go up during season, and do they go up enough for us to make like a quick decision into buying now?
Look, back in the day when I started in the business 20-something years ago, way before a lot of other people, season was a big thing. There was a noticeable jump in prices during season. Look, we live in an internet world, right? Yes, I was in the business before internet. We live in an internet world now, and it's less of a factor. Is there sometimes in sub mini markets little bumps? Do some sellers think, hey, let me raise the price a little bit, see if I can? Yeah, that might happen. Big picture, I don't notice a big, the average purchase price does not go up, big picture. Right. So it's really more of a thing from yesteryear than today.
And I think it's worth mentioning, even though, again, it hasn't impacted the real estate market very strongly yet, houses are sitting a little longer.
Absolutely.
I wouldn't expect houses the prices to go up a lot more now that it's in season.
Or if at all.
or if at all, because houses are sitting a little longer. There's
Inventory's growing.
and it's just it's becoming a buyer's market.
Yeah, and we got to see how far that pendulum swings. But
Absolutely,
it's definitely moving in that direction for the first time in a long time. Now, the other question we got was what credit score, and this is a big topic, but I'll let you run with it.
Yes.
What credit score do I need to get a mortgage? And
so
you start.
There's a lot of answers for this, right? I mean, we can spend 10 minutes talking about that. So, first of all, it's going to depend on it. When we're just talking about credit score, we're not talking about anything else concerning the credit. Just that score, that FICO score that you get, it's going to depend on the type of loan that you're getting.
Of course.
So let's just start with like the bare minimum on an FHA loan. Technically, and that's very important. Technically, the law says, FHA HUD says that you need to have a minimum of a 500 credit score as long as you're putting 10% down.
Right.
Now, having said that, let me ask you something. How many 500 credit score have you seen close?
If I round up,
in your 45-year career,
absolutely zero, right? So you just made me older than I am. So look, besides the credit score, and this is what people have to understand. There's other credit criteria. How many late payments you had, short sales, foreclosures, bankruptcy, the debt load. All of these things come into play.
They matter.
So generally on FHA, high 500s is really what you're seeing to qualify. And even in that range, it's case-to-case specific.
Right.
But, conventional's a lot cleaner than that. Conventional, you need a 620 credit score.
620.
VA, you need 600.
Sorry.
So those are some things, but again, we got to look at the whole profile of the credit. It's not just the score.
It's not just the score. And then with all these loans, we have to submit them through a system that needs to either approve the loan at the beginning or say, hey, there's a problem with this loan. And a lot of times, even though they are with the technical minimums of the 550 or the 520, that computer doesn't really like it.
Absolutely.
But again, technically, 500 if you're going FHA with 10% down.
Realistically, high fives.
High fives. Technically, 580 if you're putting the 3.5% down.
Correct.
And that's FHA.
Yeah, and like I said, conventional and VA is simpler. 620 conventional, 600 for VA, and that's pretty consistent.
Now, last question here is, if that's the case, then why there's a lot of banks out there that say that the minimum credit score is 660 or 670 or 680? Why does that happen?
What's up with that? So
is it from bank to bank? What's the deal?
Yeah, so look, you have what we call agency guidelines, as you know, right? So agency guidelines directly from HUD, directly from Fannie Mae, Freddie Mac, etc. But then any bank can choose to have an overlay. So a bank could decide, it's great that HUD says 500 credit score, I want 620. And so that's why it's going to change a little bit, which is why if you're getting a negative answer from one lending institution, give us a call, because we generally underwrite just off agency guidelines. Right. And there's a lot of loans we both closed throughout the course of a year that started off being denied by somewhere else.
And an overlay is just a requirement upon a requirement.
Exactly.
And it's very important, guys, if you get declined by somebody, ask why.
Yeah.
It's very important for you to understand, is this a you thing? Is this a loan everywhere I go thing? Because at the end of the day, we try to help as many people as we can.
Of course.
And that's the goal of here.
Of course. So,
all right, I think that's it.
Yeah, good luck, man. That was great.
All right, guys, take care and see you next week.
We'll see you next week, man.